looking at macroeconomic indicators. It's a pretty sort of dry subject, this area, but I will try and make it as entertaining as I possibly can. And we look at a number of different words and quite what they mean. The first one of these is nominal GDP. What nominal GDP means is GDP means the value of all goods and services produced in the UK in 1 year. Nominal GDP includes inflation. So, for example, on here, if nominal GDP has gone up by 15%, we may think that's really, really good. And then we've got GDP growth of 15%. However, if the inflation rate is 10%, then in real terms, real GDP has only gone up by 5%. On top of that, we also need to look at the population. And if the population has got bigger, so let's say the population has gone up by 5%, then in this case, real GDP per capita per person has not increased at all. So what we got on here is different ways of looking at GDP, and probably the most important figure to really look at on here is real GDP per capita. Okay, and then we move on to the consumer price index and the retail price index. Both of these measures are measures of inflation. The consumer price index is the index that's used throughout the whole of Europe, whereas we used to use the retail price index. The big difference between the two is the consumer price index excludes housing costs. So things like mortgage repayments and things like that. So that tends to be lower than the retail price index. Not all the time, but it tends to be lower. The slightly curious thing, we mentioned this already during another talk, is when we look at inflation, the consumer price index ignores house prices. Right, and it also ignores the stock market on here. Now, during the nice decade where we had that credit boom, 1997-2007, the rate of inflation was always kept to about 2%, primarily maybe because of all the Chinese products that we were importing, which were going down in price. However, house prices and the stock market were going crazy. So in terms of wealth, people were getting much wealthier, but this wasn't included in the consumer price index, and still isn't. So what the consumer price index looks at, it looks at an average basket of goods. So it looks at the average family, it sees what they spend, and then it works out the inflation rate from there. Now, every single good that you can buy has a weighting attached to it. So probably the most important commodity that we buy is oil. So as oil is the most important commodity, that will have the highest weighting. So therefore, if the oil price suddenly shoots up, that will have a significant impact upon inflation. Okay, so from there, but everybody really has a different inflation rate. For instance, my friend, Mr. Skitch, as it happens, is a bit of a gadget man. And so for him, inflation is probably falling because he likes buying mobile phones, he likes new sound systems, he likes getting the latest car or whatever. So for that reason, then, his inflation, because through innovation and investment, firms can produce these goods more cheaply, his rate of inflation may even be negative. However, if you're an old age pensioner who heats his house through oil and is very keen on bread and likes pork for dinner, those goods have gone up rapidly in the year 2012. So therefore, his rate of inflation may be far, far higher than the consumer price index above. So the consumer price index may be 3%, but actually his rate of inflation is far, far higher than that, and maybe about 10%. But what it does, it looks at the average family. So it's a mixture of the average family may have a bit of gadget person in there, may have some older people in there, and have some younger people in there, and they determine the inflation rate based upon them. The next word they like to work out is productivity. Productivity is just output divided by input. That's the very broad definition of it. It is probably the most important figure in terms of any economy, because if you can increase productivity, then that will increase the aggregate supply curve, and then we can run our economy at higher levels of demand. So for example, in education and National Health Service, once again in the nice decade, the government was spending loads and loads of money on those sectors, but productivity was the output of those sectors per person was falling. So the money wasn't particularly well spent. So the productivity in the public sector was falling by 3% a year, and the productivity, sorry, someone's just brought me a cup of tea.
Wall Street, I reckon like 10.
Okay. right? And then we've also got the idea, productivity, sorry, I've just lost my train of thought. Productivity is output divided by input. That was it. So the public sector productivity is falling by 3% a year, whereas the private sector is rising by 2% a year. So by spending loads of money on the public sector, in a sense, you're wasting a little bit of money maybe. Okay, the last one there is the balance of payments. Now I think this is really, really important for the UK economy. As you'll find out through these talks, I think having a trade deficit is actually pretty serious, because eventually there will come a time when you've got to pay back that debt. Now in a way the UK is getting away with it because we're selling part of our assets to other countries. So France owns our nuclear power industry. China is building nuclear power plants in the UK. The Japanese mainly own our car industry. Now the Russians are buying up our houses in London. Now that pays for the fact that you have a trade deficit. But there are two parts to the balance of payments. What I'm going to do now is just the current account, which is like the first part of the balance of payments. And here we have visibles, which is manufactured goods because we can actually see them. Below that we have invisibles, which is things like services, insurance services, education services. We tend to be positive in that area, positive to the tune of £20 billion. Net investment income is a really interesting one, because the UK has been very, very successful in the past at investing money abroad and getting profits back from those assets. But recently that figure has changed from maybe plus £20 billion to minus £20 billion a year. Now that has had a significant impact upon the UK balance of payments. And what it's saying is really that a lot of the investments in the UK from all those profits are now leaving the UK rather than coming into the UK, to the tune of minus £20 billion a year. And that is one reason why this year we have a record trade deficit, is the turnaround of this account here. So it's gone from plus 20 billion, maybe the year 2011, to the year 2013, where it's minus 20 billion pounds. So overall, we have a deficit maybe of about minus 80 billion pounds in the UK right at this moment in time, which is roughly about 5%, 5.7% of GDP. Okay, so we have a record trade deficit. So with these macroeconomic indicators here, we can tell how well an economy is doing. So right now, as I'm speaking, 2014, there's GDP growth of 3%, pretty good. The inflation rate for various reasons is 1.6 or 1.7%, pretty good. Our productivity actually is not so good. I don't know the actual figure, it may even be about 0%. So that has consequences for the UK economy, because in the long term we're going to be less competitive. The balance of payments, record trade deficit of 5% in 2013. We've always sort of been okay in the UK, because a lot of that has been paid for by foreign direct investment has come running into the UK, because we have a good supply side policy and we're seen as a good gateway into Europe. That will also impact the balance of payments, obviously, because number one, it will create more exports for us. Those are our exports, but the profits will go back to Nissan. So even though we sell more exports, which clearly will improve the balance of payments, the profits will go back out to Nissan from there. But that money that comes into the UK will also pay for our trade deficit. Otherwise we would have to borrow the money on there. So this part of the course is about macroeconomic indicators, and you just get to know those, and you know all of those terms are important. End of lesson 63. Thank you very much. Okay, we're still on lesson 63, and we're just having a very, very quick look at index numbers. Now, index numbers just give us a broad picture of what's happening. So you may get some index numbers, you may just be given these, and you're told these are index numbers for house prices. So 100 relates to 2007, 2008, 2009, and 2010. And what we can tell from that very, very quickly is, okay, the house prices have gone up by 10% between this and what we call the base year. Here they've gone up by 5% from this number here and the base year, and here they've actually fallen by 5% between this number and the base year. Now we get those figures, so it just gives us a broad interpretation of what's gone on. So it makes data easier to interpret. So overall we can say, well, in the last 4 years, house prices have in fact fallen. However, they did in fact go up by 10% here, and then they fell again from this year to this year. How do we get those figures? We start off with £200,000, house prices rise to £220,000, £20,000 divided by £200,000 times 100 over 1 is 10%, so that figure then goes up to 110. Everything's related back to the base year again, then house prices fall to £210,000, then we go £10,000 divided by £200,000, that comes out as 5%. So hence the index number for the year 2009 has gone down to 105, but overall we now know over those 2 years house prices have gone up by 5%, and finally they've fallen to £190,000. So 10,000 divided by 200,000 is minus 5%, compared to the base year, minus 5% from that, so that's 95, and hence the index number tells us a story that house prices went up rapidly between 2007 and 2008, then they fell slightly, but over the whole period of time they fell by 5%. So that's what index numbers do. They paint a picture of what is going on in the economy.